Alright everyone, Cowboy Trades here, welcome back to the channel for another update on the SP 500. Now, quite recently on this channel we've been doing a lot of analysis on the 15-minute time frame, talking about these bear flags, talking about this diamond consolidation pattern happening on the 4-hour time frame. It's been a while since we've zoomed out. Of course, a lot of the time people tend to forget what the macro trend is based on what happens in the past week or so. So when in doubt, zoom out. Let's remind ourselves on what is happening on the higher time frames for the S&P 500. So first of all, very quickly, if you are a veteran of the channel, you know that we pull up this E-mini futures S&P 500 liquidity tool to visualize when the mid price tops out here, when the mid price tops out here, and here, and here. We plot this over the S&P 500 chart, and this tells us, not in terms of technicals, but it tells us in terms of where liquidity is in the market. And if liquidity is extremely overextended, coming back up to this kind of like descending trend line for the mid price, it is a telltale sign we don't have the liquidity to push up much further. So as you can see, once again, this beautifully correlates with this macro trend line, which has been in place since the 3rd of January 2022. This has been in place for 371 days. You can see topped out, topped out, topped out, topped out, and really it hasn't been too long since we've actually topped out on this move. It's only been about 42 days or so since we have topped out in terms of liquidity and started to head to the downside. Now, for most of these moves, this one took 56 days to come down and find a new low. This one took 85 days to come down and find a new low. And this one took about 60 days. So approximately we're looking around about, 60, 65 days on average from where we top out until where we find a bottom. And you can see if we just extrapolate this, maybe be conservative and say, hey, in 63 days time, potentially we could start seeing a bounce. This would be indicative that we shouldn't be expecting any type of local bottom to take place in the S&P 500 until late January, or in my opinion, maybe around early February, because we've got an FOMC lining up with February, and a lot of the time, as you do know on the channel, we talk about this, we tend to pump into these FOMCs, we get the data that no one wants to hear, and then we start heading back down to the downside. We'll obviously keep you up to date on this, but at least from what I can see, I do expect about another 27, 30 days or so of continuation to the downside for the S&P 500. Now, outside of this macro trend line that's heading down, outside of the liquidity tops out that we've talked about, if we do head over to the Heikin-Ashis, this is just another beautiful, beautiful way to smoothen out the trend. I've talked about how these work. If you want to learn more about how these work, feel free to come over to my playlist and click on my educational series, and I have made a video here on how to use the Heikin-Ashi candlesticks. This is a very, very old video, but still very, very useful if you don't really know the Heikin-Ashis. Now, on average, I'm approximating because this isn't exactly how they work, but the Heikin-Ashis approximately open halfway through the previous candle body. And because these do this, it takes a lot more momentum to turn a green trend into the red, and it takes a lot more momentum to turn a red trend into the green. And as you can see, so far, barring like a couple of doji candlesticks, which I did explain in the video on this channel, how to Heikin-Ashi candlesticks. I mentioned in this video maybe 10 months ago or so that you do discount doji candlesticks if they do turn in the opposite color of a trend. So if we are discarding this, and we are discarding, this wasn't a doji candlestick, but this was a failed move, this doji candlestick as well, you can see there's only been one candle right here which hasn't accurately helped us call this entire downtrend for the S&P 500 in the past 370 days. You can see beautiful, beautiful red trend down to the lows. As soon as we started to tick back into green over here, we knew that we had a bounce coming. You can see as soon as we started to tick back down into red, we had a huge move to the downside, tick up in terms of green, move back up to the upside, tick down in terms of red, move to the downside, tick up in terms of green, big move to the upside. And right now, we've only been sitting in this for the past 4 weeks or so. And when we're looking at Heikin-Ashis, these took 63 days from when they turned red. This one took, until we found a bottom, 71 days. This one over here took about 56 days. And as of the time of recording, we're only 28 days into this trend. So in the higher time frames, there's just many, many signals saying, hey, discount what happens on the 4-hour time frame, discount what happens on the half-an-hour time frame. Of course, these are important. We need to learn what's happening over here to successfully trade these markets. But Higher time frames, liquidity conditions rejected from the trend line, starting to head down into that next FOMC meeting. Everything is kind of lining up with the fact that we should be continuing to break down to the downside. And just quickly wrapping up this video, very, very intuitive chart. This is the SP 500 2008 fractal. Once again, if you're a veteran, you'll know about this. We retroactively fit the top of this bar pattern in beigey color, kind of like an off-whitey beigey color. This is basically what happened for the S&P 500 in 2008, and you can see so far the peaks and the troughs, peaks, troughs, peaks, this rolling over. So, you know, once again, this is saying that we should already be nuking to the downside, but you can see this rounding top formation. While it's dragged out a little bit longer in terms of the price action right now, you can see this is another beautiful rounding top that's turning down at this moment in time, almost like another big old McDonald's pattern back down. This is another brutal indicator telling us that we should be absolutely nuking to the downside until, guess when? Early February. There's a lot of charts, liquidity conditions, FOMC meeting lining up, you know, looking at how this works in terms of the Heikin-Ashi candlesticks, looking at the trend in general on this higher time frame chart, and then of course looking at what happened in 2008. There's a lot of similarities, and they are all calling for a further capitulation into at least the end of January. And in my opinion, I think this is going to bleed into early February before we find our next local bottom, have another bounce, have liquidity conditions get overextended. We'll look at liquidity conditions on this chart and we'll tell you when is the next top going to take place. I imagine if things play out the way that they could, you know, we might even see a big move up, almost back up to this trend line, maybe even back up to this trend line. We'll of course keep you up to date on that. Just a quick update letting you know the higher time frames, when in doubt, zoom out. Nothing's changed. Don't be too worried about what happens on the 4-hour. Higher time frames, everything is absolutely still in play for that Q1 meltdown. As always, that's all I've got for you for this video. If you do appreciate the content, let me know down below by leaving a like and a comment. Share the videos with your friends, and if you do want more charts, economic data, memes, post when I am away from the market, be sure to head over to my Twitter at 618_cowboy. All I've got for you for this video. As always, Cowboy out. Peace.